Hey everyone, welcome back to the channel. Today we're going to take a quick look at Shopify, threw together a DCF on them, walk you through my assumptions there, and talk a little bit about the company. If you're not familiar, they're a Canadian-based, basically like payment processing checkout company. So if you're on like an online shop, most of their customers are small to medium-sized businesses. The e-commerce platform is probably ran by Shopify. They have about 1.7 million retailers on there. Current stock price, what is this? 1100. Market cap of $150 billion, which is pretty bonkers, honestly. So if you're not familiar, they're Canadian, so they're listed as an ADR. So they're not going to have a 10K, they'll have a 40F if you go to the SEC website. And it's broken out a little bit differently. So normally you can just click on the top link for 10K and everything's kind of like in that first link. And this, you have to go to different ones. So this will just be kind of like overview of the company is the first piece. Then you have the financial statements, I want to say. Yep. And then you have the MD&A, which is exciting stuff. And then you have like the auditor's note, some other things. So very similar to a 10K. Honestly, I think there's probably better information in this than a 10K, at least from what reading through this, I was like, it was presented a little bit easier to find everything you're looking for. Um, but real quick, high level, I'm not getting anywhere near their valuation. And so my weighted average cost of capital, this is a question I get all the time. How do you calculate that? Well, I have a video. I calculated WACC for them just because. Honestly, I think WACC is probably a little low in this instance, but 10.1 is what you get if you actually use like CAPM and the weighted average cost of capital formula. I think they're probably a pretty risky company, especially at $150 billion valuation. And I have some notes here, so feel free to download the model and read through these. These are just notes I pulled out of the 40F. This is kind of what I do every time I start looking through. And, pretty interesting company. I always thought Shopify was just kind of the cart, like the checkout cart. But I mean, really, here's like a list of all their things, right? They have a little bit of advertising revenue. Shopify Capital is pretty interesting. This was kind of got pretty big during the pandemic. Basically, they'll give loans to small businesses for working capital. Shopify Pay is basically like Affirm is a big company, but Shopify, you can have a payment plan through your cart, and then Shopify handles everything in the background. And as a merchant, you still get paid instantly. They have a shipping and fulfillment, which is what they're expanding into pretty heavily. So that could be an interesting piece of the business and where I'm giving them pretty good credit for growth. POS, this is just like Square, Toast, anything like that. It's just like, a card reader that you'd have attached to an iPad or something in a shop. And then email is kind of like their attempt at a CMR or CRM, sorry, service where you can run marketing campaigns. So there's actually a lot of really interesting revenue potential areas here, but there's only two that they really break out for us from a dollar perspective, and that's subscription, which is just like like $50 a month for their basic platform to basically host an online store. And then the other big one is Shopify Payments, which is like payment processing through the store. Um, so yeah, definitely interesting. If you don't want to read through the full 40F, I took just some high-level notes here to get you familiar with the company. But income statement, so they break it out subscription solutions and merchant. So subscription is really just like the $50 a month is like the basic, and that's what like most of their customers are on. And then they have 10,000 customers on the subscription plus service. But the basic one is like $50 a month. So I mean, almost $1 billion coming through this, but they have 1.7 million customers is what they said for 2020. And then merchant solutions, this is going to be mostly payment processing is a good chunk of this revenue. And then the remainder is just all the other stuff. And you can see kind of the margins and how they're obviously the merchant solutions, 50% margin, which is still great. But that's going to be mostly the payment processing. There's actually cost to process payments. And then subscription solutions is pretty good margins because like now that the application's developed and up and running, right, it's pretty easy to scale that. Um, Break out all of the OpEx. So this is just really the income statement. Then they do give us for D&A and amortization, they break it out by segments. We back that out and stock-based comp. So what I mean by that is if you were to come check the formulas over here, you'll see for cost of goods, I took it out of the merchant solution just because it's the bigger line, but you'll see like the subtractions up here in the formula bar. And same thing for sales and marketing, because we're trying to get EBITDA, so we want to back out depreciation, amortization. I also back out stock comp because it is a non-cash. I mean, it's non-cash from the standpoint of like the company doesn't have to lay out cash, but it is dilutive to a shareholder. So it is bad, but to the shareholders, but it's like non-cash when we're trying to get just pure unlevered free cash flow. The difference is like this gets us a equity value, but obviously over time there's more shares, so it's kind of diluted more. So if you were to convert this back to a share price based off current outstanding shares, you could do some calculation, but I don't touch that. Um, and then to project out the revenue, I'll show you what we did here. So they give us a handful of interesting stats. So they don't give us the exact Shopify payments. They like gave us in 2020 the growth rate from 2019 and then the dollar amount that it grew. So you'll see I have like so it grew by 835 million and I knew it was 121%. So then it's like I had to just calculate what the base here was and then get this, and similar thing for these other years. So I've backed into these Shopify payment numbers. They don't give them specifically to you in the 40F, but they give you enough information to get to it. And then you can back into the other just because you know total merchant. But the other is really like the fulfillment, working capital loans, things of that nature that we talked about a minute ago. Um, the subscription revenue is pretty straightforward, and I'm not entirely sure, something seems off, but they give you the monthly recurring revenue for subscriptions. And I guess they don't give us the retention rate, so maybe that's the difference. So if you take this monthly revenue, multiply by 12, that's what I've done here. You get these numbers, but you can see like this is actually higher than the subscription revenue. So my guess is, there's the retention issue. So there's clients always leaving, right? So you don't get necessarily a full 12 months at this, but um, I don't know. That's just kind of what they gave us. So best proxy I could come up with there. So now I'll talk through how we kind of projected out the future year's revenue. So first we'll start with the easy one. This is the subscription revenue, right? We can see monthly recurring revenue growth, 62, 37, 32, 53. So um, I just kind of I've assumed a lot of small businesses, this was kind of a pull forward. A lot of companies that weren't web enabled scrambled during COVID and they got web enabled damn quick, and Shopify was the platform that allowed them to get web enabled very quickly with a store. So in reality, right, this growth here, we're probably not going to see similar levels of growth to 2020. And unfortunately, pretty sure their stock price is reflective as if they continue these levels of growth indefinitely, which I think is gonna not work out well for some folks. So I've done 30% and then just kind of dropped it off. Um, I mean, I'm not really sure if there's like a good way to think of how I did this. Really, it was kind of like I didn't want it grow it like I felt like 300 million-ish a year of incremental reoccurring revenue was probably like a pretty fair proxy. Um, so I kind of like tapered off the growth rate to hold it there. And it gets to 4.4 billion. That's pretty big for a subscription service. Um, so that's kind of the first piece. I think you could look at this another way. They do give us the number of clients, kind of. So this was like, I had to pull this out from each 40F individually. They have like one blurb in the entire file saying we have approximate, or they always say something funny. It's like we have greater than 609,000 merchants. Okay, so do you have 609,000 or more than like, and then this one is like more than 377,500 merchants and more than 820,000 merchants. So they give you like these funny verbiage, but it's like a pretty good proxy, I'm gonna guess, for their total merchants. So another way you could do it is you could do monthly recurring revenue divided by merchants to get like the total revenue per merchant and see how that's growing, forecast out the merchants, right? You could back into it another way, but I just kind of made this pretty simple and had it growing about 300 million a year, and it quadruples in the next decade. So that's pretty aggressive growth, I would say, for something like that. The next piece is the Shopify payments. This is the tough part. Um, so something to look at right there, merchants almost doubled, right? We went up 75%. And then the revenue here, more than doubled, right? Went up 121%. Now, they're not going to double their merchants again, right? Like their historical growth was not that great. Like it was like, don't get me wrong, this was good. They were adding 300,000 merchants, 200,000, 200,000, but they weren't doubling merchants every year. So my thought here was kind of taper them back out to gaining, 250,000 merchants a year roughly, and have it slowly kind of decrease as they add more and more merchants onto the platform. But going from 1.7 to 3.8 million merchants. So that's still pretty impressive growth for the number of merchants. I don't know how many I mean, and that's another way you could think of this is how many small businesses are there in the world? Obviously, there's more than 3.8 million, but like, how many of them are there with e-commerce websites that are successful? I don't know. But I think that that's a pretty fair growth number based off their historical growth when you exclude COVID. I think doing Shopify again at the end of 2021 would be really enlightening because you could kind of see how did 2021 end and were they able to maintain this growth, which I don't think is going to happen. I think this is pull forward of a lot of businesses that didn't have a web presence getting online. Um, but first, we forecast out this. From here, we need to know, so GMV is gross merchandising volume. So then I calculated the GMV per merchant. But we can see it's actually been increasing pretty well. So what this is saying is like that every merchant that's on the platform has $40,000 in sales per year. So this isn't that, like this is just 40,000. This is not, so this number up here is billions. The merchants is in millions, but when you divide it, you just get thousands. So this is $40,726 per merchant on the platform, right? And it's growing every year. And I think it makes sense that it continues to grow even as the merchant base grows because you have a handful of these really large merchants on there that are really going to skew this. Um, so I guess what I mean by that is like I think Peloton uses them, right? And Peloton has just kind of boomed. And as Peloton's revenue grows, right, if they're doing $1 billion of revenue, right, then that's basically, almost 1% of the revenue comes from one customer of their GMV, right? Not of their revenue, but of their GMV. So I think it makes sense. Like you have a few companies that really take off and skew this number and grow and are super successful. And as you add more merchants, you get more of those that really take off and they're ingrained in your platform and they like it and you've been there from the start and they're loyal. I think that that's a true statement. So I think, having this growth here of the average kind of GMV per merchant growing isn't out of line. So with these two numbers now, with the number of merchants and the GMV, we can calculate the gross merchant volume on the total platform. So we have them going from about 120 billion of sales on their platform, which is up, almost tenfold from 5 years ago. So from 120 to 665. So we have them 6xing. So their rate of growth is, still pretty impressive from the GMV, assuming that those things can hold. So I think that that's an aggressive assumption, right? We're saying they're going to be doing $665 billion of merchandising volume through their platform. The next piece is the volume penetration. And this is where we could change this to be increased or decreased, but as the world goes back to normal and there's less of online e-commerce, this is probably going to go the opposite direction, I think. Now, if you're super bullish on e-commerce, right, you could increase this drastically and say everyone's only going to do e-commerce forever. No more going back to brick and mortar. You're not going to go walk around a farmer's market. You're going to continue buying from the local honey store on their website. I just don't believe it. So, you see a lot of the volume penetration here, but I think that this would actually probably decrease. So I think leaving it at this is probably aggressive. And what this is, the gross merchandise volume penetration is like the amount of sales that goes through their payment processing on the websites. So there's people that use Shopify in the platform and sell goods, but they use a different payment processor. So, I think that this is fair, and I think that that's a fair assumption. You could tweak it, have it increase, have it decrease, and download the model. Feel free to do so. The next one is just the payments piece. So that's just literally this 151 divided by 45%, and that gets you the revenue percentage. So like how much of this gross merchandising volume is, how much of that do they keep as a spread for revenue? And it's 2.715% is what I'm using. Historically, right, it's been 2.7 to 2.8, just kind of varying. And this is a calculation I did. After you calculate it, you can take the Shopify Payments revenue, divide that by the GMV volume for payments, and that gets you the percentage. So think of this as like, right, if you use like Square or PayPal or something, they charge you a 3% credit card fee, or Venmo, right? This is what that is. Um, so, it's never going to be something crazy. It's never going to be 5%. And I think a lot of those things are in the probably 2.5 to 3% range. So, 2.715 seems fair. After you have all these numbers right, then we can calculate the payments revenue, which is just the payments now divided by that percentage. And we have it going from 1.5 billion up to 8 billion. So the next piece is the other. I have this actually still growing really aggressively, and that's what I kind of mentioned earlier. Um, they mention over and over again, they're really kind of like doubling down on fulfillment. So I think that they are going to see more and more fulfillment revenue come through here. So I have this continuing to grow at a pretty aggressive clip, right? And it becomes a $5 billion business from 500 million. So, I think that this is probably one of the bigger areas for growth if they can really figure out this fulfillment stuff, something similar to like Wish and all of that stuff. Like if they can have a good logistics fulfillment network that these merchants can rely on, it could be a really big value proposition. So that's a quick little overview of how we get the revenue numbers, link those back up to the DCF, right? And then the last things we need to focus on are the remainder of our assumptions down here. So tax rate, simple enough. Federal tax rate, 21%. You could probably use a Canadian tax rate, but I think actually 50% of their revenue is derived from the US. I honestly don't know how the US-Canada tax relationship works. I don't know if I don't know if they pay Canadian tax, if they pay some US tax for the US businesses. Honestly, don't know. Didn't want to take the time to figure it out. It's a pretty basic assumption anyways. And then in their 40F, they mention sales and marketing, research and development, and general administrative are all going to decrease over time as a percentage of sales. They say like the net dollar amount will continue to increase, but as a percentage of sales, it will decrease. And, you know, actually this one starts to, that's weird, it does start to decrease down after a while. So that one might even be a little aggressive on the decrease, but that's fine. So we have it as a percentage all decreasing. And I have a note, do I say what page? Page 13 to 15 of the MD&A, they talk about all of these things. And then kind of like some of them, they say why they think that is. The next piece is the Cogs. So subscription and support, I held flat. They say it's going to fluctuate modestly based on the mix of subscription plans and the timing of expenditures. So what that tells me is like this is a pretty fixed percent of like margin. Like it doesn't, like if you sell more premium plans, your margins improve. If you sell less, they decrease. But like if we look historically, it's been 20 to 22%. Hold it at 21% seems safe. The next piece is they say cost of merchant solutions is expected to increase as a percent of revenue in the short term due to continued investment in the fulfillment network. So that leads me to believe that, we'll probably get closer back to like this, even probably above 60%. But what I've done is I've just added back a percent a year until we get to 62%, and then I've held it flat. And with all of these assumptions, which still has revenue growing 37, you can see the revenue growth here going from 37% taping off to 12. I mean, I guess you could increase this, the perpetuity growth. You could say they're actually still going to grow pretty well post. But I mean, you get a $40 billion valuation. Let me see. I don't think there's like a formula error or something here. No, there's not. So I mean, I think the valuation they're seeing currently and what I'm getting from a fundamental perspective is just night and day different. And if I had to guess, like if you really wanted to make this, you know, if you wanted to get the similar growth or like the similar valuation, um, I think the key here is really you'd have to just you have to assume they're going to continue at some like crazy growth for the next like I don't like what if we like even increase this 3% a year until 75% of everything, right? And then 20 billion in revenue. I mean, you're still just like so far off. Let's see. Yeah, no, I mean that's gross profit, right? D&A, subtract those out to get EBIT, taxes, add back this, subtract this. So, I mean, I don't know. This is a tough one. I don't see how you get the valuation that they're at. Just, right? I mean, if you have Shopify Payments 10xing, you have this 10xing, right? I mean, we could even increase this to be 10x. What is the driver here? Just this, right? So we go from, let's just like leave this at 30%. Does that get us closer to like 9 billion? Oh, there we go. So we have every line of business 10xing, just about, right? And then we're still only at 66 billion. So we're going from 3 billion to 30 billion, which is just crazy. Cogs, I mean, as they mention, they tell us they're going up as a percentage for this and they're staying flat for this. So it's not like we're making poor assumptions here. And I guess maybe you could be like, oh, it's going to go up only 0.5% a year or something. I mean, I just don't, and I guess you could be more aggressive and say this goes down 2% a year or something. Like, can we even, I guess what I'm trying to say is like, obviously you can't have a negative percent of sales, but they say the absolute dollar is still going to increase for these things. So for sales and marketing, does it still increase every year? Yeah, so in 2027, I guess 2026, right, you can't even have it decreasing that amount because we need it to still be increasing in absolute dollar terms, which here it doesn't. Oh wait, yeah, it does, sorry. So like still increasing in absolute dollar terms. And then what about R&D? Is it doing the same? Does the same, but like what if we get more aggressive and decrease a percent a year? Does it still increase in absolute dollar terms? It looks like it does until here. And then just do a 0.5%. Let's see, which one's R&D? So it's still increasing in absolute dollar terms. And then G&A, hey, let's do this minus 1% a year. Okay, until 2027. Then we need to come in here and update that to be this minus about like 0.25%. So, because they tell us the absolute dollar amount is still going to increase, even though it's going to decrease as a percent of sales. So I think even if you take these assumptions, right, you have revenue growing 10x in the next decade. Everything else is basically the company's projection or assumption. You're still just like, I mean, you're still like not even like, right, 150 billion. We're getting 90 billion. You know what I mean? You're still, only 60% of the way there. Um, I've seen some aggressively priced companies, and I think Shopify is up there. Um, and maybe I'm missing something. Maybe like there's some just crazy growth driver, and like maybe 10xing revenue like is the bear case. But after reading the 40F, I didn't see big solutions. And they even mentioned in their 40F, I think I recorded a note on it where they say, um, I'm not sure where I wrote it down, but they mention, yeah, right here, they're going to experience a decrease in GMV, but that's going to be offset by retail business increase partially. So they're saying like their GMV is going to decrease, and we have it just like growing like gangbusters. Um, I don't know. This was a fun one to look at, and I think the company itself is incredibly interesting. But I also think it's just incredibly overpriced. And I think slash this in half, and you're probably at like still an aggressive price. But I don't know. I could be missing something. Love to hear your thoughts and comments. Leave them below. And yeah, thanks for tuning in, and feel free to download the model and tweak any of my assumptions.